Back to the Tech Wizards show again here in April of 2022. And again, guys, my name is Doc Severson. For those of you who haven't met me before, I've been around in the business since 2005. I quit my job at a three-letter acronym telecommunications company back then to trade for a living. And it wasn't long until after that where people were knocking on my door and asking for help and seeing if they could do the same thing as well too. So almost at gunpoint, I got into the coaching business, but I really enjoy it. I really love it. I love working with people. I love making a difference in their lives to them because there's so much at stake these days. So you may have heard of me at some of the past sites that I've been around, which is Options MD or TradeOutLoud, Doc's Trading Tools, or the old Options Linebacker. And currently, right now, what I'm running is ReadySet.trade, as well as ReadySetCrypto.com. My specialties over the years have turned into, you tend to kind of narrow in on what you like to do. And it's multiple time frame or fractal price analysis. And I trade those using options and future strategies. And through necessity over the years, when I couldn't figure out why I was doing silly and stupid things, I've had to dive into and become an expert on the trading mindset. And so because of these, what I've done is written a couple of books on Amazon, which are available. So if you just search under my name, Doc Severson, you can find these out there. Fractal Energy Trading is my most recent one. So it's multiple time frame trading or one trading system. And actually, we're going to talk quite a bit about this today. And then the trading mindset book is Hacking the Holy Grail. Everybody's looking for the Holy Grail. It's actually between your ears. If you want to ask me any questions after today's session, it is doc@ReadySet.trade. Okay, what do I want to do here today? Well, I want to help you guys. I've been trading the live markets every day. Since 2004, I've made every mistake that a retail trader can make. I made them all, guys. So much of what I'm sharing today was learned by necessity and usually at great cost. So I've tried about every system out there, from the simple to the complex, the longer the trade, the simpler that I want my decisions to be. I've got a whole bookshelf of trading books, and really I could probably boil it down to just one or two now. Trading is a relatively simple process, right? But we make it complex. So today what I'd like to do is to give you a few simple, powerful ideas and hope you're able to create a masterpiece with these over time. So copy everything that you read here today and use it in your own trading. Okay, so ready, set, let's get started. And I always like to start by outlining what the problem is. So this is what we do as engineers, right? Is give me a problem and then let's work on the solution. So the problem that we need to fix is accurate charting and price discovery, leading to a directional trading edge. So our own embedded human nature ensures that we start the wrong way. We all start the wrong way. So unless you're lucky enough to snag a job on the street out of college, everybody starts in the same manner. They get lost in a crowd. And we do the same things because we go back on what worked for us in our professional lives or our own personal lives. We are herd animals after all. We feel strength in numbers. We feel safety in a crowd. This is why one of my favorite things to do is to join 100,000 of my friends and go see a football game on Saturday afternoon. It is in our very nature. This is embedded in our DNA to go with the crowd. We feel very, very uncomfortable going against the crowd. We want to go with the crowd. We feel safety in numbers. So this is our embedded DNA. Everybody starts out like this. So we're also used to social logic. We trust social opinion. And especially in the last generation or the last 20 years or so, really since Amazon took off, it was about 22, 23 years ago, Amazon became very, very popular. Everybody looks at the star ratings, right? So if you want to go get yourself a ninja sword machete, what you're going to do is search in Amazon and you're going to look for something that's got at least 4 or 4.5 stars. You're not going to bother with the things that are only 2-star or 3-star. You're going to just assume, and you're going to trust everybody that went before you and bought the ace martial arts supply, ninja sword, machete throwing knife, tactical katana, tanto blade, that they know what they're doing. Or if you want to eat something, if you go into Yelp and you're particularly hungry for bacon, we've got the Bacon Bros here at 4 stars, and you're going to trust that because it's a 4 stars out of 5. And so for the better part of a generation, we've outsourced, or we have socialized our decision-making process. So what do we do when we get to financial markets? We do social investing. Why can't we do the same thing in markets? So the first thing that people do is they join a Facebook group or a Discord server or some kind of Telegram group, or they get into some kind of private Twitter. We all do exactly the same thing. And then we follow the group, right? We follow the crowd. And so this is a problem because retail traders are going in financial markets thinking that the safest thing to do is just to go along with what everybody else is doing. So trading has become just another extension of social media, especially with Wall Street Bets and Reddit. Now, the results of social investing is you're going to get chewed up. I mean, if you want to see the loss porn, just go onto Wall Street Bets sometime. And every day, some other poor soul is posting their loss porn and saying, hey, I started with 50,000 and now I have 500. Aren't I cool? No, you're not cool. It's not cool to post loss porn. There's no reason to go through this. There's no reason to YOLO your entire account into one trade. This is never going to work, guys. So what people do is once they figure it out, they say, look, maybe social media is not the way to go. I've been burned so many times, et cetera, et cetera. They go into the investing media. Well, guess what? They're not your friend either. They're there to get clicks off of you. They're there to get eyeballs so that they can sell ad space. They don't care about what you're doing. I mean, some great examples here, like here's Kramer, old Kramer, you know, like poor guy, he's been doing this for a long time and he takes a lot of arrows, but recently he was saying Netflix, buy, you know, and they just got destroyed on yesterday's earnings release. So not a good, like 38% down. This guy was during the pandemic, Bill Ackman got on CNBC, and this is in, I want to say mid-March of 2020. We were kind of fumbling our way through the pandemic at that point. You know, it wasn't that bad. We were maybe down, I don't know, I want to say maybe 15% in the markets at that point. And he got on there and he literally scared everybody to death because he's like, oh no, this is the worst thing in the world. And Bill Ackman does carry some weight, does carry some gravitas behind what he says. He's like, we need a 30-day shutdown. We need to shut down the entire economy. And boy, I mean, he was talking his book. He was entirely short and he covered like a day or two later. And so he gets on a program, scares the market to death, and then covers into that. The investing media is not your friend, guys. I mean, you know, we could go on, but the more you stay away from that type of stuff, the better off you do. So most investors are just like, oh my God, what am I going to do here? I can't follow social media. I can't follow the media. I need to find a guru. So what you end up doing is you end up bouncing around. And I bet you there's a lot of people out there that have done this before. You follow a guru for a while, you take a trade or two, you don't win. And so there's another guru over here and he looks like he's got a great program and it looks like you can't lose. So you go thundering over there, take a couple of trades, you lose those two, you get discouraged. There's another guy over here selling another program that looks really easy to follow and it's cheap. So you go thundering over there. And we just go into this big circuitous route all the time, just looking for the guru, looking for somebody to teach us how to make money, looking for the easy way to make money. And we're doing it all wrong. We're doing it all wrong. Okay, so that's how we all start. And hopefully you guys understand what I'm talking about. And maybe some of you agree with what you've been through. Maybe this sounds real similar, maybe a little bit too much. But what you got to do is you got to find your way. Everybody out there has got to find your own way out there. There's one very narrow path to success in trading the markets. And it's well known, but it's difficult to follow. It's one thing behind knowing something versus another thing and actually forcing yourself to do it. So when you find your way, you know what you want to trade. You've stopped trying to be jack of all trades. You're no longer trading futures and crypto and stocks and options and bonds and everything out there. You've got 42 screens up in your office and you've got everything moving. You're a jack of all trades and a master of none. So once you understand what you're doing, you're going to narrow down what you trade. You finally know what you trade and why you trade it. Okay. You also have a plan and you're treating this like a business. Failure is not an option. Now, price discovery used to be right in front of your face, right? It was the sounds and the sights and to some degree, even the smells of price discovery of the traders right in front of you. If you've ever seen these in the Chicago trading pits, it's quite an experience. But they're all dinosaurs. They're all fading away pretty soon here. But the price discovery used to be easy to figure out when everybody was either buying or selling. It's right in front of your face. But now today's challenge is you got to figure it out on the screen. And a lot of guys that used to trade on the floor have not made the transition very well to trade upstairs. And when they're trading off a screen, it's very, very different. And so to some degree, the retail traders of today have a little bit of advantage because we never did trade in front of a pit, right? So solitary price analysis, just you and the chart. How are you going to do this? That's today's challenge. Okay, so you got to find your way. Now, this is where I run into the scenario of people thinking that more is better. So if I just add one more study to my charts, that'll be the difference between me being successful. So when we can't get a grip on what's going on, this is what we see. And so a lot of us, you know, obviously we want to start with price. So we start with price on our charts. And then of course we have to add some moving averages so we can figure out what the trend is. And so somebody told us that we've got to use a MACD. I mean, if you're going to be a professional, you've got to use a moving average, convergence, divergence with a histogram on there. My gosh, you can't even imagine not trading with a MACD, right? So besides that, you need an oscillator to tell you what to do by whether you're oversold or overbought. Okay, so now we're starting to get into a standard chart study, but now you find out about the RSI, the Wells-Wilder RSI, Relative Strength Index. And so, of course, you've got to have that on there as well, too. And then John Bollinger's invention to add volatility envelopes out of here. Of course, you've got to have that on there. And no chart would be complete with also adding the Keltner channels to understand whether or not you have a squeeze going on. And then, of course, you need to add the Arun oscillator, which somebody said worked 100% for them. So, of course, you have to add that. And then eventually the ADX, so you know what the strength of the trend. Guess what you've done? You've just buried your price action. You've just basically obscured everything that matters by overriding it with all these studies that are on there. So this is typically what I see from retail trader charts is that they've got so much stuff going on there. They've turned themselves into, you know, like they can no longer make a decision. So they've turned themselves into a pretzel. And what a lot of guys end up doing at this point, or ladies too, is trading not to lose instead of trading to win. And there's a big difference between trading to win versus trading not to lose. So I want to share with you today, the 4 simple rules that I boiled things down. So this took me a long time to get to this point. And I've borrowed things off of Charles Dow. I've borrowed things off of a lot of giants that have gone before me. And I've tried to boil things down to 4 basic rules that I apply towards every style of my trading. And I want you to steal these today, please. Let my pain over the past, you know, let you go a little bit easier. That's what my hope is today. So I've clarified these down to 4 basic rules. And this is what I'm going to share with you next. Okay, so the 4 rules of fractal energy trading. Rule number 1, larger time frames dominate the price trend. And I'm going to teach this to you guys in ways that analogize things that you already understand. That's my hope here. So what you want to do is choose an anchor chart, understand the trend and swing direction, trade in the direction of the anchor chart swing. Larger time frames dominate the trend. So the best analogy for this is if you're walking a dog. So let's say you're walking your dog from point A to point B. And let's say you've got a very curious terrier, like I do, that has to sniff everything and mark everything within the span of their leash. So as you walk from point A to point B, this is you, the owner, what you're going to find is your dog is going to investigate everything within the orbit of their leash, right? It's going to check out over here, then run over here and everything like that. Now, notice that you both arrive at point B at the same time. However, the dog took a much more circuitous route to get there, all over the place, within the orbit of the leash. So who sets the beginning and ending points of your walk, though? You do. You're 10 times the mass of your dog. You are the anchor chart. So if the dog starts to get a little bit too far out of bounds, you're going to pull them right back into the orbit. If the dog goes a little too far over here, you're going to pull them right back in there and you're going to arrive at the same point. This is the same thing as a larger time frame chart with a smaller time frame chart moving around it, right? So even though you see things happening on a larger time frame chart, looks like one big swing, there's a lot of volatility that occurs within there at smaller time frames. So think of the dog and you. So that's our anchor chart versus signal chart. Say, like, for example, the weekly chart can just be going through one big swing here to the upside. And on an hourly chart, which is our signal chart, signal means this is where we're going to take the signal from. The anchor means this is the direction that we're going to trade in. So this one big candle here on the weekly candle is this hourly signal chart. So we're going to use this. We're going to trade in the direction of the anchor chart, which is rule number 1. And we're going to use that signal chart to enter it. We'll get into that in a minute. So to apply rule number 1, understand what larger time frames to add to your signal chart to create an anchor chart. Use an anchor chart. Most people that are out there just use a daily chart and that's it. And that's fine because it allows you to understand. It's probably the most viewed chart that's out there is the daily chart. We care what happens on a daily basis. But add an anchor chart and trade in the direction of that anchor chart swing. That's rule number 1. Now we get to rule number 2. This is the exact opposite. Reversals start from the inside out and they propagate higher. Reversals that happen, in fact, we just had a little reversal on the S&P 500 over the last couple of days, and it started with an hourly chart reversal. Didn't start with a daily chart or even a weekly chart. Started with a much smaller time frame. So understand the process that change happens from the inside out. Things change from smaller to larger or from the inside out. A virus infects a single host cell. And then that host cell, once infected, begins to multiply and infects other host cells. So change happens from inside out like this. If you drive your car every day and you don't notice items wearing and degrading until somebody else drives it, have you ever noticed that? Somebody else gets in your car, like, whoa, what happened to your brakes, dude? Or, man, your transmission shift's terrible, or your clutch is slipping like crazy. You don't notice those things because you're driving it every day. You've gotten used to it. But change happens from the inside out. Change is often small and imperceptible until it becomes a big deal. Just like rust. Rust starts with one little, one little place in the car. Next thing you know, you got complete cancer on your body panels. So here's signal chart reversals. Here's something where you're looking at maybe like an hourly chart here, and you're watching these price movements going higher high and higher low, and all of a sudden you go to a lower low, lower high, lower low. That's a reversal. Okay. Bottom reversals, lower highs and lower lows, and all of a sudden you print a higher high, higher low. There's a reversal right there. So we can see these. Now I'm going to show you a simpler way to catch reversals, but I want you to understand that if you had nothing else on your chart, but maybe price on 2 different time frames, you could trade with that, and you could trade very, very accurately with that. In fact, that's what a lot of pros do. They don't need any garbage on their charts. They just trade based on price. So change propagates higher. Here's a good example of a daily chart reversing down here in the left. This reverses into an uptrend, form a downtrend, reversing into an uptrend. And eventually what happens is the weekly chart, that's that reversal way down here. And then the weekly chart finally reciprocates and does the same thing as well too. The weekly reversal takes much longer to occur though. This is why we would need a smaller time frame signal chart. Reversals propagate higher in time frame. So how do we apply rule number 2? Understand what smaller time frames to use for your signal chart and it's going to be an application of what you're trading. So we'll get into that. I'll show you 3 applications in just a minute here that you can use to trade different styles of trading. Okay, so reversals come from the inside, they propagate higher. Rule number 3, you'll like this one. This is simple. Ascending patterns break to the downside. Descending patterns break to the upside. This is just a filter. This is not a signal or a signal. So what goes up must come down, vice versa. So an ascending pattern will break eventually to the downside. Similarly, a descending pattern will eventually break to the upside. How can we use this in conjunction with everything else? It's simple physics, right? So we can set up signal chart trend lines, like on our hourly chart. Here's an hourly chart, and we can start to anticipate. So when we break that trend line, it's not necessarily a signal to go long in this case, but it's one more filter that we can say, like, look, we don't want to take anything until it gets past the trend line break, and then we'll take the first entry after that. So this is just very simple. Rule number 3. Descending patterns break to the upside. Ascending patterns break to the downside. Again, what I want to encourage you or to reinforce here is that this is more of a filter than an actual entry or exit signal. There's a lot of volatility right around turns, so you can get chopped up if you use this as an actual entry signal. So this does add confluence to reversal signals. It strengthens them. Okay, that's rule number 3. And then we get to rule number 4. I think you'll find this interesting, and there's not a whole lot of talk about this in markets. You may hear a little bit about this, but you're probably used to hearing about overbought and oversold. Somewhere along the way, traders got fed this notion of an asset being overbought or oversold. You see it all over the place in social media. Oh, that chart's overbought, or this chart is oversold. It must reverse, right? So we render judgment upon charts being overbought or oversold. It must go the other way. Well, no, it doesn't have to, right? There's no limit on the money printing, although they are starting to taper now these days, but my gosh, they're still doing it. Just because they're tapering doesn't mean that they're stopping. So I think the notion of overbought and oversold is obsolete. Markets can remain irrational longer than you can remain solvent. I have watched this happen over the years so many times where markets will just keep grinding and grinding and grinding and grinding. And everybody's like, hey, but it's overbought. It's overbought. It must reverse. It's overbought. It must reverse. And these people literally will go insane arguing on the internet or social media that, it has to go in the opposite. There's no law that says anything has to occur. So I'm just not a big fan of overbought and oversold. Markets move differently these days. They run as far as they can until exhaustion. And actually, I would say that they go a little further than that. They go way further than that. And then they run into consolidation. So the way that I explain this is that instead of overbought and oversold, I think that markets will trend or range expand until they go into exhaustion, and then they'll move into range contraction, which is consolidation. So trending goes to consolidation, and then this range contraction will continue until the chart recharges or re-energizes, and then the price moves to range expansion again. This cycle repeats forever, not this notion of overbought and oversold. Markets copy nature. Think about somebody trying to summit Everest. What are they going to do? They're going to check in at the base camp. They're going to go as hard as they can and get up to camp number 1. They're going to be wiped. There's no way that you can summit Everest in a day or even 2 days, right? You're going to get up to base camp 1 and you're going to be gasping and wheezing. You're going to need to acclimate yourself to a lower level of oxygen. So you may even stay there a week. Range expansion goes to range contraction. And then when you're ready, when you've recovered, you're going to go up to camp 2. Range expansion goes to range contraction. You're going to go through the same thing again. It's going to be even more difficult. It's going to be tougher. Range expansion, range contraction. Again, this is how markets copy nature. We do the same thing. We go as hard as we can, then we rest. We do the same thing every day. We rest every night. Range expansion, range contraction. There's no overbought and oversold in nature. So how can we measure this on charts? Well, there's a little known study called the choppiness index, which not every platform has. Even Thinkorswim does not have the choppiness index out there. And what it does is it shows the linearity. And it's almost like a fuel gauge in the way that we can use it. So if you consider this to be full energy and this to be empty, so we have full energy ready to move. It's going to move in some direction or another. We don't know which way. When it gets to exhaustion, it's going to consolidate, and then it's ready to move in some direction. We don't know which way. Boom. When it gets to exhaustion, it's going to consolidate until it's ready to move again. Boom. Range expansion, range contraction. We see the same cycle again and again and again. It's not overbought, oversold. So we can start to understand how this moves, and we can even do it on things like tick charts or intraday or longer term charts, anything. And we can combine them together into fractal arrangements. The choppiness index helps me see the modes switch between expansion and contraction. When we get to this point, when this thing is all wound up like this and it's fully charged, we know that a break of this box is going to occur at some point. We don't know which way it's going to occur, but we know it's going to happen. And typically, by rule number 1, it's going to go in the direction of the larger time frame swing, isn't it? So we're going to start to put this all together in a minute. So applying rule number 4, using these principles will give us an early warning when a consolidating price chart is about to break out, as well as the converse warning when a trending price chart is about to stall out and rest. If you think about this, I can trade this for directional. So directional breakouts like this, or when I see a trending price chart going into exhaustion, isn't this a great example for something like a calendar spread, iron condor, iron butterfly, something like that, right? So for those of you that understand option strategies, this kind of puts everything together for me. All right, so I use the chop index linearity of the current trend to determine exhaustion and charge levels. Range expansion leads to range contraction and vice versa. Not overbought, not oversold. Okay, so we've done everything now. There's rule number 4. So let's measure energy and direction. Let's put everything together. This study, the chop index, is the best way I've found to measure the extremes of expansion and contraction. Again, this is an example where it's going sideways. It's full of energy. It's ready to go. Boom. Now it hits exhaustion. Down here, it's ready to consolidate. We can use this to understand how markets move. Now, measuring direction is always going to be the tougher thing here, right? So we can measure price action, price is always going to be the most accurate way to do this, but quite honestly, it's hard. A lot of people have difficulty understanding how price moves, right? So how does price move, and understanding the polarity of the price movement, things like that. So we can use oscillators. Most standard oscillators are trailing signals. They're way behind the actual reversal in price. Look at this, because it's like a study of 14. So here's this, you know, it's 3 days behind this crossover, 3 days behind this crossover. It's 2 trailing, right? We can't tolerate that. So what I'd like to do is to introduce you today into a combination study. And this has got both a choppiness index in here in the yellow showing, as we talked about, you know, full energy and then empty down here like a fuel gauge. And then what I've also got on here is the RSI in Laguerre time. So if you want to drive yourself nuts, go on to Google and start searching for the Laguerre time transform. Basically what this is most studies are going to do a count back, say like 14 bars. So it's going to look back over the last 14 bars and then give you a sample based on price, time, and volume, whatever. It's going to be a derivative of price and time. Well, what the Laguerre time transfer does is it's more adaptive to what's going on. So if the price suddenly starts to trend, it's going to shorten that time frame. It's going to be more dynamically responsive to what's going on. And you're welcome to go look through the Laguerre time transfer and the theorems of that. And if you can figure it out, great. All I know is it's much more responsive and adaptive to signal changes. And this is where we're using it for. We're using it for signal changes where something in the upper zone is heading down and hooking down. In this case, this would be a short signal, but not against the major trend. What we're more interested is going in the direction of the major swing in this case. And here's the entry point. So this is what we use this for, is signal entry. So if you're good with price action, great. But if you're not so good with price action, this is going to help you. This is going to be a nice crutch, the RSI in Laguerre time. Okay, so now let's put everything together. The RSI Laguerre with embedded fractal energy, one study, which is on the bottom side here, shows us the dimensions of energy and direction. So again, notice how quickly these things will show the hooks on these signals. Really nice. If we're going in the direction of the major trend, here's our anchor chart showing us what direction we want to swing in. Very simple signals for this and not delayed like most of our linear oscillators. Okay, so let's put everything into gear here. Let's show some different steps. All right, so step one, we're going to anchor the trade direction. Should we trade long or short? Depends on the trend. We want to trade with the trend, but also the trend depends on which time frame we're looking at. So this is why we use that anchor chart. The selection of the primary trading time frame for our strategy. So buy and hold trades are going to be a lot longer. Intraday future trades are going to be a lot shorter. Okay, the context is massively important. So somebody just following a small time frame chart is going to get whipped back and forth. So you can see just up in this area here, this is a weekly consolidation. You're not going to have any trend that's going to survive from that until it gets out of this consolidation box. So going to a smaller time frame will keep you in play. Larger time frame charts are much more powerful. Remember, that's rule number one. So determine your anchor and signal chart pair. So we've talked about this before, weekly. In this case, maybe it's a weekly anchor. Maybe we're doing some swing trading. And we're going to use an hourly signal chart to enter our trade. Again, it depends on the application. Use the anchor chart to determine what direction offers the path of least resistance. If I'm going kayaking, guys, I want to go downstream. I want to kayak downstream. I don't want to kayak, even though you can kayak upstream and these little eddy pools and do that kind of stuff. I want to go downstream. So I want you to think about what is it going to take for you to go in the path of least resistance? And I'll keep saying the same thing here again and again. Trade in the direction of the anchor chart swing. Now, here's a cheat code, which is the Heikin-Ashi candles. So you guys are probably aware of the Heikin-Ashi candles. This is a nice cheat code. If you have difficulty figuring out what direction to go in, just go in the direction of the Heikin-Ashi candles. Now, I would not want to be going necessarily, it depends on the context, right? If you're in the middle of this big, strong trend, I would not want to be going short counter trend on this big, strong trend, even though occasionally you'll win. You want to be going in the direction, not only of the trend, but also the bigger swing, which is the upside. So I would save it for the green candles until we have a change in polarity on this chart. So step number one, understand what primary trend time frame to select to fit your trading strategy. So that's going to depend on what you're trading, whether it's futures or whether it's a longer term swing, or maybe you're selling puts or whatever you're doing. So trade in the direction of the anchor chart swing, larger time frames dominate the overall trend. Okay, so that's step one. Step two, signal the entry. So step one was getting in sync with where the market's going. Is it going higher? Is it going lower? Is it just chopping around? Now we're going to focus on the entry. Reversals are the holy grail of trading, right? We all want those reversals. They're also the most difficult, right? So here's a chart which is trending to the downside, and then shows a change in polarity with a higher low, higher high combination. Boom, right there is your reversal. A true reversal of trend offers the very highest reward to risk for a trade because it allows you to set the stop for the smallest value and also gets you in earliest to what could be a big, big trend. Okay, so no argument there. So again, we're not going to spot reversals on the anchor chart. The anchor chart is just too big and lumbering for us to spot reversals on. This is why we need to use the signal chart. Change happens from the inside out. Okay, so signal chart reversals are like these. We went into this before, like here's that reversal. We can spot them on the signal chart up and down, or we can also use the RSI, right? Change propagates higher. We talked about this before. Daily chart reversal propagates into the weekly chart. So what we're looking for, when we get an anchor direction, again, remember that anchor direction, in this case, we're heading higher. What we're looking for is signal chart reversals. What's the signal chart reversals? Well, we can get these on price. And if you're good with price, you can see that this is a reversal right there to the upside. There's your entry. Here's a reversal to the upside. There's your entry. Here's a reversal to the upside. Here's your 1, 2, 3 entry. But you can also use the RSI for these. We'll get to that in a minute. Okay, so here's what I like to do is I like to select and differ the time frames by a factor of 5. So in other words, if we're using a weekly chart for the anchor, so weekly anchor chart, if we divide that by 5, we can trade the daily chart as the signal chart, or we can divide that by 5 again and use a 25-to-1. And I will use this from time to time, 25-to-1, and then go down to a 78-minute chart. 78-minute chart, that is 5 times faster than a daily chart, at least on the stock market, right? So on a futures market, it doesn't make any sense because it trades more than 6.5 hours a day. If I'm using an hourly anchor, maybe I'll use the 12-minute signal chart. This is typically what I'll use in crypto. Or 1,000-tick anchor chart, well, 200-tick signal chart for futures. Depends on what you're trading, right? So step number 2, understand the larger and smaller time frames that you're going to set up. Depends on what you're trading. Now we get to step 3, and we're going to speed up here. We need the help of one of the most accurate studies around. So the challenge here is finding these reversals on the signal chart. And quite honestly, this is tough for most retail investors to do because they're using their brain and they're trading with feelings instead of through signals. And it is a difficult transition. So the RSI Laguerre with embedded fractal energy will allow you much better signaling. In fact, you can even alert on these signals as well too, using the RSI and Laguerre time in the fractal energy study. And this is where we use the hook up, right? So here's the hook. Here's the hook signals that we're looking for, hook signals right there. When something goes into the green zone here and then hooks up, this is the signal that we're looking for in the context of an uptrend. So remember, step 3 is the same thing as everything we've been doing to this point, identifying the anchor chart, trend, swing. Once we're comfortable with that, we're going to go down to the signal chart, look for a pullback, a reversal, and then we can use the RSI hook signal to help signal the entry into this signal chart trend. And actually, we can even automate this. We can create signals that are going to be farmed out to our email inbox and tell us when to take the signal. So now let's put everything together and let's do some swing trades. So let's apply the 2-pane fractal strategy and do some swing trades. So we can do this like if we want to do like daily and 78-minute, this is a 5X arrangement. And we can use TradingView as a good example of this. We can use Heikin-Ashi candles, and here's all of our hook signals. So we can take each one of these as our swing signals. Each one of these is a hook off the signal chart on the right-hand side. That's the manual chart setup. Now the automated, what we're going to do is we're going to change this slightly. We're going to use Thinkorswim here, and we're going to use daily and 60-minute chart. It's not quite a 5-to-1 arrangement. It's a little bit, it's close enough to count. And so we're going to use the 60-minute chart for a signal chart. And what we're going to do is we're going to automated scan. We're going to scan this on an automated basis. And this is actually what it looked like. We get these type of signals coming out of our scanner and being sent to our email inbox. These are the actual signals that get sent to our platform in ReadySet.trade. So we define these based on the scanners, and we just wait for the signals to come in. We don't have to sit there and look for them and do all. So this does all the work for us. And it depends on which stocks you want to look at. We set this up with a specific small watch list that we maintain. And these are great. These are very accurate. So again, strategies with something like this, we have about a 1 to 3 day hold time. We don't typically buy stock at these levels, so we normally play debit spreads, $2 wide debit spreads, and look for about a 50% profit. And these have been very, very accurate for us. So those are our swing trades that we're looking at, which are just quick little swing trades, and we're letting the power of this study do the work for us. We're doing the heavy lifting through the study. Or we can also do intraday options if we want to. So we also do intraday options. And what I like here is I like using tick charts for this because they give much better chart action if we're looking at tick charts. And I also like using the futures to chart by, although we may be using the options. So for like example, if we're going to chart the NQ, which is the NASDAQ futures, we could also trade off of the Qs. So not everybody can trade futures Some people can only trade equities or equity options. And so this is a good example for them. So again, using tick charts. And the reason why I use this is because it creates much better patterns. It's volume adaptive. Doesn't print candles if there's no volume there. So everything that's printed matters, and it creates much better patterns to trade off of. TradingView does not support tick charts, to my knowledge. So what you can do is trade these directionally through options. And you can also determine these, and we will do these on a 0 or 1 day option. So you can see in this example, this is a 1 day option. And we know that if the Qs moves 1 point, it's going to move from basically $1.56 up to $2.18. So we know what kind of a gain, or that would be a $62 gain, if it moves 1 point. This is an old market maker trick that we use with trading options for that. Again, the accuracy for these are, you're going to be long the front at the money option. And the most you can lose on the trade is the debit paid if you're just going to use long options like this. So typically we don't do that, though. We're just trying to get in, get our fair share, and get out as quickly as possible if we're doing this. Now, a much better way to trade intradays through futures. And again, I'll use tick charts for these. Use Heiken Ashi. In this case, this is, I'm trying to remember that. Oh, this is TradeOutLoud. Yeah, this vendor is TradeOutLoud. This is a chart on TradeOutLoud that I've got. So I'll use something like this, and notice that this is still a 5-to-1 ratio, 1375 tick, 275 tick. And this is the MNQ or the NASDAQ E-mini micro futures. And then, of course, if you're going to trade futures, please use a ladder interface. Don't try to do this through the standard order entry. Use a ladder interface and learn how to use this, and use one cancels other bracket orders. So what you want to be doing is if the current price is here, what you want to be doing is, say you went long here, you want to be setting up a sell limit up here and a sell stop wherever that is, right? So this automatically creates a one cancels other bracket order around that. And typically what I'll do this on is the micro NQ, a micro E-mini NASDAQ, or micro E-mini ES S&P. Although you could also use anything for that. So futures are the best thing to use intraday, but never trade without a bracket. Okay, folks. So that is 3 different examples of swing trades, options, futures. Let's summarize everything, get you on your way here. So step 1, what do you do? Step 1, select an anchor chart. Okay, I know this sounds repetitive, but I want, repetition is the mother of skill. You should always select an anchor chart for what trade in the direction of the anchor chart swing. If you just remember that little phrase, you'll save yourself a lot of grief. Step 2, figure out a signal chart. If you're going to trade in the direction of the anchor chart swing, what time frame will you use to jump onto that trend and take that direction? So select a signal chart, which is a 5x multiple of that anchor chart. Step 3, add your tools, maybe Heiken Ashi's, maybe the RSI Laguerre study, moving averages, whatever is necessary to make you feel comfortable, but please don't overload your chart. Notice this is TradeOutLoud, and it's also got the RSI in Laguerre time and the CHOP index. Trading instruments, depends on what strategy that you're doing. So we'll typically for swing trades, we're going to be using front week debit spreads, limited risk, limited reward, and allows us to hold out with no time decay until the trade's ready to pop. Intraday options. These are very fine instruments, very sharp instruments, so use them carefully. And futures are for intraday scalping only. Not going to hold them overnight because of the margin changes. Use the RSI in Laguerre time. in conjunction with the choppiness index. Reduce the number of studies that you have. Really, this is all you need. That and price action. And filter like crazy. Filtering is about standing to the side when conditions are less than optimal. And this is something that I go into in my Fractal Energy Trading book. So that's out there as well too. Again, that's on Amazon. Okay, so once you gain experience, you'll be able to see conditions that are offering higher versus lower probabilities. Okay, so what do you do from here? How do you morph all of this stuff that I just went over in the last 50 minutes into your trading? How can you start doing this, right? So you'll get the replay of this presentation, but it may take you a while to get going with this. Consider joining our community if you want. So ReadySet.trade is a community of traders who seek high probability, low risk trades in the options and futures markets. We're trying to make something simple and doable, like make $100 a day on a regular basis, right? So goals are for people who care about winning once. Systems are for people who care about winning repeatedly. And that's what we focus on is systems. This is the kind of stuff that we do at ReadySet.trade. We have a live daily trading room that I moderate, 5 times a week newsletter. We have a live online community, which you can get a look at right now. Strategy briefs, courses, we've got everything. I hate to say it's the Netflix of trading education. That's probably a poor analogy these days. So I've got a course that's out there that'll teach you how to trade this 2-pane fractal and also use the RSI Laguerre study. We have assets and resources that allow you to get up to speed on there. So we're offering a sale on this course, for it's only $47.99. So for what you get for this course is kind of amazing. Let me go through what's actually in this. You can see the different modules here, the basic elements of the 2-pane fractal arrangement, and we'll show you how to do the RSI in Laguerre with embedded fractal energy. So everything with that study, how to get it loaded, application for swing trades, application for intraday options, and also for futures. So quite a bit of material in there and a lot of resources for $47, right? So also what you get is member access. You get member access to our platform at ReadySet.trade. It's not the full elite access, but it's going to give you the signals. You'll see the signals that come through from these types of signals. So our results over the years, we've been doing this now for a couple of years, since 2020 in ReadySet.trade. I've been doing this personally for 17, but our results from this, we're winning 81% of the time, a little bit more than that with the 0 DTE trades. And our profit factor right now is about 2.53 over the last couple of years. That means for every dollar that we lose, we're making 253. So it's a machine, right? Just put money into the machine and learn how to be a consistent trader. This is what we do. So what's that link again? It is ReadySet.trade/2. Please don't use an iPhone. We're not set up on the Apple Store, and so it won't let you buy if you use an iPhone or an iPad. We could add that, but then it would add a lot of cost to the course. And so we're trying to keep this very, very inexpensive and accessible for everybody. I have just a couple of minutes left for any questions if anybody has them. Otherwise, you can reach me at doc@ReadySet.trade. Can you use the Laguerre on NinjaTrader 8? I do have that available. I would have to, it's going to take some archaeology, but I do have that available. It is not part of the course. You would have to come to see me personally. Okay, any other questions? All right, please join me online with this course. There's a tremendous amount of value for a very small cost. We're just trying to show you what kind of things that we can do for you at ReadySet.trade. I look forward to seeing everybody online. And again, thank you very much, David, for the invitation to join the Tech Wizards here today. Hope you guys have a great Wednesday. And that's it.